I'm Brad with Wooten CPA, and my goal is to bring peace to your tax and financial responsibilities. One of the ways I do that is through these videos on YouTube. I take more of the complex, harder to understand tax and financial topics, and I try to break them down into simpler, easier to understand videos. And so hopefully this video will do that for you. Today we are talking about tax rates and tax brackets. So have you ever heard anyone say, I have this much income and I'm a little bit worried about the raise I'm going to get. I need to find some deductions because as soon as I get a little bit more of income, I'm going to be thrown into that next tax bracket, and that is going to cost me a lot more in taxes. So typically what they're thinking here is that when they get into that next tax bracket, all of their income is going to be taxed at that rate. Is that how it works? No, that's not how it works. So let's step back, take a look at an example so we can see how your tax bracket and your tax rates actually work with your income level. So today we're going to use some example tax brackets to make this much simpler. We're not going to use the actual, we're going to use these example tax brackets so that our calculation will be a lot easier to do. So our tax brackets from $0 to $10,000, everything will be taxed at 10%. $10,000 to $20,000 will be taxed at 20%. And from $20,000 to $30,000 of taxable income will be taxed at 30%. So let's say your gross income is $50,000. This is what your W-2 shows as your taxable wages in box 1. Now, as you know, there is itemized or standard deductions that you get to take. There also might be some other items, but we're going to keep this very simple for our calculation. So we're also not going to use the actual standard deduction. I'm going to simplify this for calculation purposes. So let's say the standard deduction is $25,000. That's a little bit higher than what it actually is for a married couple filing joint right now. We'll use it again for simplicity's sake. That is going to give us taxable income of $25,000. So, under the misunderstood way of calculating taxes, we might think $25,000 is in this $20,000 to $30,000 range, so it is going to be taxed at 30%. So if we tax $25,000 at 30%, that's going to be $7,500 of tax payable. That is not how this works. We do not want to do that. Now, the way we do want to do this is we're going to take our $25,000 of taxable income and we're going to tax it through the brackets as it is done appropriately. So the first $10,000 will be taxed at 10% or $1,000. Our next from $10,000 to $20,000, that's another $10,000, will be taxed at the 20% rate. That's $2,000. And then our final $5,000 will be taxed at the 30% tax rate. So that will be $1,500. We add these up, 2, 3, 4, $4,500. Our tax is $4,500. This is way better than the $7,500 that we calculated under the incorrect way. So again, as you can see through this example, when you reach that next tax bracket, only the next amount of money that falls into that tax bracket is taxed at that rate. All of your other income is still taxed at the rate it was originally taxed at as it goes through the income tax brackets. So I hope that this video simplified a little bit more of a complex topic as far as tax rates and tax brackets go for you. Please comment below. Don't forget to subscribe to my YouTube page so that you can watch the videos as they come out, and hopefully they'll be as helpful to you as this one was. Please leave comments also about whether or not you thought this video was helpful, how I could improve upon it, or other topics that you want discussed. Thanks for watching the video.